It's August, and we've got another market update for you. I'm David Shapiro with my colleague Lee Abraham here at the Shapiro Group. If you are thinking about buying or selling or just want to talk to us more about real estate, shoot us a text. Our info is below. We'd be happy to chat with you. And this month, we've got something new. We've got the Real Home Price Index for you, which is going to take into account not just the nominal price, which is most people talk about with inflation. We're actually going to adjust for inflation. We're going to adjust for income and mortgage rates and just see where prices are compared to historic levels. And we've got the normal stats for you. I even pulled up something I found on Twitter. So let's dive in and talk about what we're seeing here in Austin. So here we have the number of active listings for August. You can see peaked at just under 4,000 active listings last month, and it's come down slightly.
Right. So not only has there been a slight reduction in the actual number of listings, but the monthly housing inventory is down from what we were reporting last month. So you take your 3,748 active listings. David, over the last 30 days, we've had 781 pending sales. So that translates to a 4.8 month inventory. We look at these stats, the high indication is from the 12-month average, where we were averaging 672 sales a month. So that's an indication of some increasing velocity, although still fairly anemic relative to historical pace. Bottom line, we're still hovering at around a 5-month housing inventory.
And here that is over time. So you can see we peaked just a couple months ago at 5.2 months of inventory, and we're down a little bit, but like you said, pretty close to that 5, and that's kind of where we've been hovering, which seems to be the peak each year over the last several years, although the timing of that peak has been different. So it'll be interesting to see how this plays out into the fall. And we've got some theories on what might happen here. So we'll get into that. This is a chart that I found on Twitter, and I thought this was pretty interesting from Resi Club. And so this goes back to 2013. The blue line is the sellers. The orange, yellow line, whatever you want to call that, is the buyers. And you can see the big gap of more sellers than there are buyers right now. And here's the peak of when things were nuts in 2021, when there were a ton more buyers than sellers. And just the average over the last 10 years, there were periods where there were some more sellers. Right here, there's these two periods. But I just have to imagine this reminds me of what we talked about last month on the special report. If you have not seen that, I talk about the trend lines in Austin. This is just nationwide, so this is not specific to Austin. So if you want to see specific to Austin, we did a special report. I go over some really interesting trend lines. And to me, this is pent up buyer demand. Like in a growing country, why is our buyer demand just continuing declining? I think it should probably be somewhere in the middle here. And so I think there's a lot of pent up demand. But I think this is a really interesting chart just to see that nationwide, we do have a lot more sellers right now than buyers.
Yeah, I haven't seen this chart yet. So this is the instantaneous reaction segment. I'm just curious how they calculate the number of buyers. I'm wondering if that tracks back to mortgage applications.
Yeah, it could be. And this is Redfin data. So they have a lot of people going on their website and looking at homes so they can track kind of real time how many people are on there clicking around. But I did not look into that. That could be
that'd be interesting.
Question.
Yeah, just in terms of interpreting that gap and translating that to pent-up demand, it'd be interesting to see how qualified those buyers were in that segment. Are they simply viewing online, or are they actually completing mortgage applications? That would be interesting to see.
Are you saying like, okay, if these buyers aren't completing mortgage applications, then they're just viewing online, is this buyer demand even lower than what we're seeing here?
Right.
Interesting. Yeah.
Because we know that the listings, if we look at the supply demand dynamic and a balance of intention, we're looking at intention. So the listings are listed. The sellers have gone through the process of signing a listing agreement, putting it on the market. They're bona fide. And so that's my question, is how much of a differential is there between the two sides of supply and demand?
Yeah, good question. All right, back to our normal programming. So let's go to the number of sales per month. And here you can see in July, we had 737 sales, down 10% month over month, which you can see last year it was up month over month. And although in 2023 it was down, let's go back to, we don't even have a normal year on here anymore. It's all these abnormal years. It's crazy. We've been 5 years in this, abnormal market. Wow.
So I think we're going to start calling it the new abnormal.
Yeah. And so I will say, if you haven't heard me say this, what we're dealing with now is certainly abnormally slow compared to what we had seen in the general trend of 2011 to 2019, but probably closer to normal than 2021, which was just insane on the other end of this spectrum. So the pendulum has swung.
Yes.
And I think we'll come back into some sort of a calibrated normal level in the near future, whether that's in 12 months from now or 24 months. But saying 24 months doesn't actually feel like that far out when things have been slow for 3 years. Let's see,
Right.
It started to slow summer of 2022. So yeah, 3 years now. All right, sale price, what do we got?
So average sale price, once again, up year over year and down a little bit month to month. But, I was speaking with an agent a couple days ago who had shown one of our listings. We were talking about price trends, particularly in the neighborhood, but in the Austin MSA. And he was talking about a declining market. And the conversation basically turned on the facts, which is, every month for the year, we've been up year over year in price. The only way that you could characterize our market as a declining market is relative to the peak, which was what, May 22?
Yeah.
That's the only time you're really looking at a declining market is the peak in 22. It's not a declining market. It's a stable, gradually appreciating market, David. So, that's just a point of friction as we try to overcome the public misconception and media doom and gloom when in fact the numbers, they speak for themselves.
Well, I'll play devil's advocate, my favorite thing to do, which is we've talked about this idea that the really high quality properties are selling. And I was reading a very interesting statistics real estate publication last night, and it used the term composition effect, which describes that, which is that it's a little bit of maybe a perception thing that really high quality properties are the ones that are selling. And the people that have seen their home value decline by 40%, which are probably on the rare side, but even 25%, they're not selling. They're stuck waiting because it's not that they're stuck. They probably even have equity unless they bought in 2022 or maybe in 2021. But the majority of people have equity in their home. Or actually, and by the way, if you bought in 2022, you could still possibly have equity because you put down 20%, even if you saw an 18% decline from you bought at the very top. But people have actually are up since they purchased their home. The value's up because they purchased it in 2020 or prior, even though they've seen a decline from the peaks, but it's because of this composition effect. They're not one of the highest quality homes that's selling at a premium still. And so that's what's propping up our average home price. And that if every home were to go on the market that people actually want to sell, we wouldn't see this stable of a market. That would be the argument.
That's a very abstract argument to make on a variety of levels. And so I wasn't taking notes to counterpoint exactly what was going on there, but it's a fragmented market with segments and price points and expectations accordingly. So we totally agree that terrific properties that are free of adverse conditions are more in demand. Properties that need work and everything else, they're going to drag if they're not priced right. So it's a great conversation. David, you and I know that the only way to really measure price appreciation is with paired sales analysis.
Mm-hmm.
And we'll do a special report on that perhaps. So these averages, whether you're using the median or the average, you're looking at trend lines over time to just kind of gauge pricing. So there's a lot of abstraction, particularly in that devil's advocate segment that we just went through there.
Yeah. I will say, if you are a buyer and you're thinking about buying, there are deals out there. Like you could be finding the one forced seller. And the big difference from 2008 great financial crisis to today is forced sellers. We don't really have that many because everybody who wants a job for the most part has one. That was not the case in 2008. There was lots of layoffs. And mortgage rates, for the most part, are fixed. Most people got a fixed mortgage. That was not the case in 2008. So there's way less for sellers, but that doesn't mean that there's zero. There are still people that need to sell their home, and there are opportunities out there for buyers. So if you're thinking about buying, I think it's a good time. We've seen some people get some good deals. Now, we can't call the bottom of the market. We can't say today is going to be the absolute lowest price we're going to see from now into the future. So there might be a slightly better buying opportunity, but don't try to time the market. If it's a good time for you lifestyle wise, you should just go ahead and do what's right for you and your family, and don't try to time markets. That is extremely difficult. All right, moving on. Here we have the real home price index. So First American Title put this out, and what you see here on the blue line is nominal values. So, and this is on you can see 100. Everything was adjusted to 100 on January of 2000. And basically what this is showing is what you think of when you think about home prices, that they have gone up substantially. But what it doesn't take into account is inflation, doesn't take into account mortgage rates, doesn't take into account people's income, right? Because along this period, people's income have gone up and inflation has happened. So when you take that all into account, you get the orange chart. And it's a very thick line, unfortunately. But I put a red line here to show you, here's roughly where we are now. And here are some periods previously of high unaffordability. And we're above that. And we were even further above that going back to 2023 and 2022. But a combination of wages going up and prices coming down a little bit has, and by the way, this is for Texas specifically, has brought that down. So what I was curious is, okay, here's some periods of unaffordability. We're still above those. What would it take for us to get back to kind of standard? And so the average nominal house price index is 128 and the real average is 91. What we'd like to see is affordability around 25 to 30% of income. And with current mortgage rates around 6.5%, that puts affordability at about 40%. So that's why we talk about this affordability crisis. To get us to where we want to be at a 30% income ratio, we are going to make a couple of assumptions. One, that home prices don't drop. Two, that incomes don't increase. Three, a 20% down payment. And four, that somebody's going with a 30-year fixed rate mortgage. So if all of that happens, the rate needs to be about 4 to 4.25%. So you can see here, if this is the 100 line, right? So the average of this orange is actually below that, around 91. So somewhere in here. So you can see we're well above the average, but 4 to 4.25, that's the target to get affordability back. Now, my assumption would be that you're not bringing rates down to 4.25% without bringing home prices up. So I don't foresee us getting back to that affordability rate. I think the new normal is that we're going to be above a 30% affordability, which is unfortunate for a lot of people, but that's just the reality of what happens when you're in a housing crisis. There's just not enough supply. We need to build more homes. I was actually curious, what does this mean? Like, there's just not enough homes. Well, the way that shows up in the real world is people, like younger people in their 20s, not moving out of their parents' house as early as they might otherwise. More people having roommates, those types of situations. There's not new household formation in the way that there would be if there was more supply and more affordability.
I'm just trying to process the chart. I mean, the only thing that really jumps out at me is the new abnormal. So now that's been used twice. So, if you look at the gaps that you marked with the arrows there, even though compared to the blue trend line, which makes the adjusted rates seem more nominal, it's a big jump to the current dynamic. And it's a huge jump to look for a 4.5% mortgage rate. And then your point well taken regarding if rates do get that low, prices are going to go up and all that. So this is the new abnormal. And what does it mean? Well, it's squeezing people out of the market, and that's the bottom line. That's the traditional market. So I'm thinking that there's going to be more of a demand for co-ownership. We know that co-housing is a trend that has traction in some markets. And I'm starting to think that there may be some more ownership models that allow people to crowdsource a little bit, because it's just human nature to adjust to the situation. So I don't see this as a doom and gloom, the market is dying or that type of thing. I'm thinking a little bit more on the supply side on how to address this.
Yeah,
One other thing with that, David, just specifically in Austin, was the recent,
it's
correct,
the acronym is HOME, the HOME Initiative.
the home initiative, which
Yeah.
is now allowing for 3 homes on a lot where previously there was 2. That is perhaps the first manifestation locally in Austin of what I'm talking about, where the supply side adjusts to the new abnormal.
Yeah, the other thing that you remind me of is I bet if we were doing this video update about Tokyo, you know, 10 years ago, whenever it started, 20 years ago, whenever it started getting expensive, or Seoul, I'm thinking of these cities where they have these tiny micro apartments, right? They adjusted. They made the unit size smaller so it could be more affordable. And that is partly what's happening here with the home initiative is we're adjusting. We're allowing 3 homes per lot. We are increasing the density so you can actually go to a higher what they call FAR, Florida area ratio, when you do those 3 homes. So we're increasing density. Austin actually has probably, if you're pro affordability, the problem here is a lot of people own property. Like half of Americans basically own real estate. And so if you're in that half, you want prices to go up. So, as much as you may like the idea of affordability for people on whole, you also don't want to see your price value go down. I think there's probably a balance here where like prices can gradually go up and affordability stays in line. But Austin has done a really good job of building supply. We built the second most and absorbed the second most number of apartments in the country last year, just behind New York City, which is phenomenal. That a city, we're the 11th largest city. And that means numbers 2 through 10, we built more apartments than they did, which just blows me away that we were able to do that and really have taken on this affordability crisis better than pretty much any city. And that's why you've seen values come down from their highs. Rents are down significantly, which I think ultimately is good for Austin to be able to keep some of the younger talent. And, we're not pushing everybody out because of prices. Although some people watching this might feel like, oh, no, it is still getting expensive. But it's all relative when you compare this to some of the other parts of the country that have not done as good of a job with building. And, I know in my neighborhood, there's one of these new 3 home complexes going on. Separately, my neighbor is building one of these in another neighborhood. So they are going up, and you're going to start to see these, which is pretty cool to see us innovate. And I think, the articles of Austin that we saw leading up and during the pandemic about how this is the number 1 city to live, it's such a great place, those have gone away. But I've got a theory that they're going to come back, and that Austin is going to continue to be a great place to live, and we're going to innovate in many ways. So, all right, moving on back to the stats.
All right, days to sell. Pretty much stable, down slightly year over year to 46 days to sell, same as last month. No real movement here. We're expecting this number to kind of hover at this level and then tick up as we get into the fourth quarter based on seasonality. So I think that's another special report that we'll roll out here at some point, David, is shifting seasonality. How do we measure it? Which markets? Right now we're looking at a theory on the luxury side. We're doing a lot of work over on Lake Austin, and we're becoming more and more intimate with a lot of the details there. And part of it is the seasonality trend and all that. So anyway, we're looking for this to hover and then start to tick up as we get into the fourth quarter.
And here we have the sale price to list price ratio down both year over year and month to month, which this thing moves. Recently it's only moved a little bit. Do you think this is enough to be substantial? Almost 1% year over year at 0.8.
I think it just reflects the market that we've seen, which is slow. And so it's in alignment with the other indicators. And again, a nuanced but oddly accurate reflection of market sentiment. So it's a little soft right now. New listings, they're up year over year. Oh my gosh. Kind of in alignment with where we were in 2023. Down month to month. That's fairly typical now as we kind of round out the seasonality that we've been talking about. So yeah, no real news here, basically in alignment with the other stats that are talking about general stability in our market.
And then our housing barometer, and this is the most real-time stat we came up with to measure this. So if you were a buyer or seller, you're trying to decide, okay, what do I do? Do I sell now? Do I wait? Do I buy now? And what we're showing here is the number of new listings by week and the number of pending sales by week. And then we get a ratio, and then we chart it over here. So the 100% line is what you're looking at. And so there's some brief periods over the last couple of years where we were below that, which means that inventory was declining, but the majority of the time we're above that. So inventory has been growing. And this is part of the picture, but Lee, I'll let you talk more about.
Yeah. So if we just look within that red outline there at the number of new listings, they're in the mid to upper 200s compared to the previous report where they were in the 300s. So that's one way to look at the listings being down. And then the pending sales being up compared to the previous 4 weeks or so. Let's go to the next chart, David. And then now we're going to be integrating withdrawn and expired listings. And so interestingly enough, we've had a couple of months or a couple of weeks rather, where the expired and withdrawn listings played a significant role. And last month we reported that 4th of July weekend, there was a huge number, 206 listings off the market due to being withdrawn or sold. Happened again just this past week, 107, bringing the retraction of the number of listings down by 55. So at the end of the week, there were 55 less listings than there were at the beginning of the week. That's good for values. So, supply and demand, supply being down a little bit, demand being up. It's just the formula for stability and slight year over year appreciation as we break these numbers down.
And we will note that these were the end of the month. Listing agreements tend to just expire at the end of the month. So that is a reason why those weeks in particular, and I bet if we looked back here, it's definitely not what's interesting is even going back to the periods that included the last day of the month. So like here's March, still not negative compared to what we're seeing now. So that is interesting.
Yeah.
And here we have it charted in a slightly different way. So Lee, what are we seeing here?
We're just looking at the pattern that we want to see, which is new listings, the blue line, and the pending sales in the red line being pretty close to each other. The closer they are as they both move up and down, that's what stability looks like from this vantage point. So I like what I see there.
Yeah, and we had talked about this a couple months ago. They were far apart. It looked like they may have been going in the direction where they're actually going opposite, but that has reverted and we are now coming back closer to an alignment. So
right. Take a look at one thing, David. We've been talking about the volatility of the market, and you mentioned earlier that you were looking for some stability over time, whether it's 24 months from now or whatever. It seems to me that the gyrations are more violent now. And when you just look at the drops and peaks of the past several weeks, it's kind of manifested, I think, as you look back to, a couple years ago, just look at how they were more in lockstep. So I'm looking for a bumpy ride.
All right, and we've got mortgage rates. So 6.6% on the 30-year, the 1-year change up 0.16. So basically flat over the last week. So really not much change here.
Right. Yeah.
This is the magic number. Like in my estimate, and if you're watching this and you have been wanting to buy and you are not, please comment below why. Is it because of mortgage rates, or is it something else? Is there something else holding you back from buying? Is it that you think prices are going to go lower and you want to wait? I'm very curious. My guess is the majority of people are waiting on mortgage rates. This number has not changed. I think once we get below 6, that there will be a decent number of people that will come back in, but 5% for sure is a magic number. Like that gets you close enough to your current 4% mortgage that you're like, all right, well, I really need the extra space. I really need to move closer to my job. Whatever the reason is somebody would want to move, that they're hopefully within striking distance and they're not psychologically stuck, or maybe financially stuck because they can't actually afford to go to the home that they want to or need to go to. But I think a lot of people psychologically, it's really, really hard to go from I was just with a friend. She bought her house in 2020. And she's like, David, my mortgage payment on this beautiful home with a pool in a suburb of Austin is $3,500 a month. It's like, how could somebody like that move to an equal home, which has gone up in value, now would have a higher mortgage rate? She'd probably be spending close to $10,000 a month to live in a similar home if she needed to move to a different neighborhood. So it's really hard, whether it's psychologically or financially, to justify that.
Right.
And so I think 5%, we get to a point where like the majority of people no longer feel that pressure. But I think even just getting below 6, that'll help open the gates a little bit. But every month that goes by, or every quarter maybe is more accurate, more people have either bought a new place and their rate has adjusted to norms, or they've not done that, but they're psychologically spent more time at these interest rates. And if you're to look at interest rates over time, we're not that high in historical terms. It's just really high compared to the last 10 years.
Right. Yeah. I mean, I've mentioned it before on these podcasts. I bought my first home when rates dropped to 12%. So I came into the market, in 82, interest rates were 17, 18%. So there's a lot of historical precedent, but it is the new abnormal. We do have those handcuffs on interest rate pricing where people, just aren't going to give up that rate. Over time, that erodes. People have to sell. But the one takeaway is that there's so much political pressure to lower the interest rates that I'm having a hard time imagining that not happening. Even in a measured pace rather than, something radical. So,
yeah.
Lee,
by the way, I was not born when you bought your first house. I bought my first house in 2006. So I'm curious how many people watching this video were not born when I bought my first house.
Interesting times. I can assure you.
I don't know. Do we have any 20-year-olds on the call? Actually, no, you'd have to be 19. So any 19, 18, any teenagers on this call, comment below if you're a teenager and you're interested in real estate, you're researching it. I'd be curious to know.
Mm-hmm.
All right. Well, you can always find us back here at realestatevideohub.com. We put these videos up every month talking about the market and updating you on the statistics with real data, and it's just not headlines. So if you got a lot out of this, share it with somebody, give it a like. And if you want to talk with us more about real estate, just go below, schedule a call directly with Lee or shoot us a text, and we'd be happy to chat with you. Thanks for joining us, and we look forward to talking to you next month.
Thanks, everybody.